Welcome everyone to the fourth meeting of the Joint Interim Standing Committee on Commerce and Labor. We will call the roll first. For those members attending virtually, please turn your cameras on and respond when you hear your name. Ms. Roll, would you please take roll?
Senator Lang.
Here.
Senator Settlemyre.
Here.
Senator Spearman.
Here.
Assemblywoman Duran.
Here.
Assemblywoman Hardy.
Here.
Assemblywoman Kasama.
I'm here.
Assemblywoman Marzola.
Here.
Chair Howdigi.
Here. Thank you, Ms. Rowe. If you would please indicate that all members are present. Before we begin, I would like to make several housekeeping announcements. First, I would like to remind everyone in person here in Las Vegas and in Carson City to please silence all of your electronic devices, especially cell phones and laptops, during the meeting. For members joining online, please mute your microphone when you are not speaking, but please leave your camera on. Additionally, I ask our presenters on Zoom video call to leave your cameras off and microphones muted until I call the agenda item under which you will present, or if we direct any questions to you. I would like to remind everyone on Zoom that the chat feature is only to be used for technical assistance, with assistance from BPS. Any links or information or questions should be shared verbally on the record and not shared in the chat feature. The committee's meeting materials can be found on the Nevada Legislature's website. You can also sign up for electronic notifications related to any activity on the committee's website. When testifying in person, please turn the microphone on to speak and off when you are done. We have listeners and viewers in Carson City and online, and we are recording this meeting, and it will be available on the legislature's website. We will have public comment period at the beginning of our meeting as well as at the end of our meeting, and public comment is limited to 3 minutes per speaker. In addition to testifying in person, members of the public may provide public comment in 4 different ways, all of which are listed on the agenda. You may provide public comment by calling in 669-900-6833, entering the meeting ID number 848-8760-4518, and then pressing the pound sign. When prompted for a participant ID, please press pound again. You can also email your comments to the committee's email address and mail them to the research division, as well as fax in your comments. You can find the public and fax numbers and email address and mailing address on the agenda. With that, we will move to public comment and begin with those present here in Las Vegas. Is there anyone in Las Vegas wishing to give public comment? Okay, seeing no one, we will go to Carson City. Is there anyone in Carson City wishing to give public comment? Okay, BPS, could we please check the telephone lines for anyone wishing to give public comment?
Thank you, Chair. The public line is open and working, but there are no callers at this time.
Okay, thank you, BPS. Okay, committee and those who are listening in, I would just like to remind you guys that there will be another public comment period at the end of the meeting, and you can also submit your public comment via email, mail, or fax. We can now move on to agenda item number 3, which is approval of the minutes for the meeting on April 5th, 2022. Are there any questions regarding the meeting minutes, committee members? Okay, anyone on Zoom? Okay, I would entertain a motion to approve the minutes of the committee meeting on April 5th, 2022. So moved. I have a motion by Vice Chair Spearman, and I have a second by Senator Settlemyre. Any discussion on the motion? Okay, all those in favor, please signify by saying aye. Those on Zoom, if you would just raise your hand. Aye. Aye. Okay. All those opposed? Okay, motion passes unanimously. Thank you. Okay, we can move on to our next agenda item number 4. Our agenda today focuses on topics related to insurance. At our first interim meeting, it was noted the legislature provides the regulatory framework in which the Division of Insurance, Department of Business and Industry, operates by establishing laws that grant the specific regulatory authority and approves operating budgets. The insurance market in Nevada is divided into 4 segments. 1, health insurance. 2, property and casualty insurance, 3, life and annuities, including accident and limited health products, and 4, title insurance. Over 15 measures relating to health insurance and other forms of insurance were passed by the 2021 legislature. First, we will hear from the Division of Insurance of the Department of Business and Industry, which serves many critical roles in our state, including licensing insurance companies and agents, regulating policies and rates, and serving consumers through education and complaint resolution. I believe we have Commissioner Richardson with us on Zoom. Commissioner Richardson, when you're ready, please begin.
So first, I want to make sure everybody can see my screen.
Yes, we can, Commissioner.
Perfect. Okay. So I want to say good morning for the record, Chairwoman Howdigi, Vice Chair Spearman, and members of the committee. My name is Barbara Richardson, and I'm the Insurance Commissioner for the state of Nevada. And I was asked by the chair to spend some time with you discussing the role of the Nevada Division of Insurance, the types of products and industries we regulate, the status of the division regulations, and issues that we expect to be addressing in our 2023 BDR and other general issues that the legislature may want to be aware of. So the slide before you talks about the gross national product for the domestic United States. So the insurance industry is the second largest financial sector in the United States. And this accounts for roughly 37% of the gross domestic product produced by financial institutions. And while financial industries such as banking and securities are primarily regulated by the federal government, the insurance industry has always been predominantly regulated by the states. Insurance risks and hazards often vary between states, from natural exposures such as weather and earthquakes to unique industries such as Nevada's mining and gaming. The federal government has maintained its localized understanding of the insurance industry and believes that those risks for localization of the risks themselves makes the states the best suited to regulate the industry. The Nevada Division of Insurance is responsible for the regulation of insurance sold in Nevada. We are first and foremost a consumer protection agency. Our primary focuses are twofold: the solvency of carriers doing business in Nevada to ensure the company is able to make good on the promises that they've made to their consumers, and market regulation, which is to provide an adequate and competitive marketplace for Nevada consumers. And this includes making sure policyholders and claimants are treated fairly. So premiums written by insurers doing business in Nevada are approximately $20 billion per year. These have grown by 77% in the past 10 years. We have roughly 1,600 traditional insurers and 161 captive insurers authorized and regulated by the division to engage in the business of insurance in Nevada. The number of insurance producers licensed in Nevada has also grown by approximately 30% in the past year to over 220,000. This number includes over 25,000 Nevada resident producers. We've seen a huge spike post-COVID, and we've seen this dramatic increase, we believe, has been since the beginning of March 2020 and its effect of COVID-19 on the economy itself. So in general, insurance premium taxes are the fourth largest source of revenue to the state's general fund, and they account for 10.5% of the general fund's annual revenue. The insurance premium has grown from $234 million in 2010 to over $452 million in 2020. The largest sector of Nevada's insurance written premium is health insurance, which had $7.7 billion of written premiums in 2020. This is followed by property and casualty at $6.4 billion of written premiums, and a little over a half of the property and casualty written premiums come from automobile insurance. So this slide reflects the sources of healthcare for Nevadans, and the four sectors shown at the bottom are the primary providers of health premium taxes to the state. The four include Medicaid managed care, small group, individual, and large group insurance. The Division of Insurance regulates both the forms and approves the rates for individual and small group insurance, which accounts for roughly 7% of Nevada's covered health care. The essential health benefits that are mandated under the Affordable Care Act only apply to individual and small group health insurance markets. The large group market, which accounts for roughly 10% of Nevada's health coverage, is not subject to any kind of rate filing or policy approval by the Division of Insurance. The largest sector providing healthcare coverage in Nevada is self-funded plans, and that covers approximately 32% of Nevadans. These plans are federal or ERISA plans created under the Federal Retirement Employment Security Act of 1974, and they're regulated by the Federal Department of Labor. So these self-funded plans are not subject to Nevada premium taxes and health insurance coverage and benefits that are mandated under the Nevada revised statutes. They also do not apply to these self-funded plans, other than employees covered by PEB or other Nevada government agencies who have those type of government self-funded plans. So the division currently has 65 active full-time employees with offices both in Carson City and Las Vegas. And the division, just like many other of the state agencies, has been affected by the employee migration, and we are currently understaffed. As a consumer protection agency, our consumer services section staff historically receive 11,000 to 13,000 consumer inquiries and handles roughly 3,000 consumer complaints every year. Over the past 7 years, the division's 8-person consumer services section has helped consumers recover over $40 million in payments or refunds related to consumer complaints. The division regulates the industry under the 59 chapters contained in Title 57 of the Nevada Revised Statutes and the 4 industrial insurance chapters, along with corresponding chapters of the Nevada Administrative Code. In addition to the traditional insurance products we regulate, such as home, auto, commercial, and life, the division also regulates title insurance companies and their agents, which ensures the titles of properties that are purchased. We also regulate risk retention groups, which are groups that are formed to ensure liability risks of the owners of these RRGs. An example of this would be a group of doctors that create an RRG to protect their risks from being sued for malpractice. The division also regulates travel and portable electronic insurance. Some additional products that the division licenses and regulates are service contracts, which encompass products like home and auto service contracts and extended warranties in appliances, prepaid funeral and cemetery contracts, motor club contracts, annuities, and sureties. The division also regulates viatical settlements, which is when an insurance or life insurance policy is sold to a policyholder from a policyholder to investors. The division also oversees the bail industry, which includes licensing and regulating bail agents and agencies along with bail enforcement agents. So this predominant slide basically is here so I can talk about the National Association of Insurance Commissioners. So the Division of Insurance is part of a state regulatory system integrated in the National Association of Insurance Commissioners. The NAIC, which is the National Association, is governed by the insurance commissioners from the 50 states, the District of Columbia, and the 5 U.S. territories. Most insurance carriers licensed to conduct business in our state are domiciled in other states. The majority of insurance companies transact business in multiple states or multiple countries, and many of the insurance carriers who offer products in Nevada are national or international companies. Through the NAIC, the commissioners work together to create a regulatory framework that provides increased uniformity, especially when we're talking about solvency controls, information sharing, and IT support to help create more efficient markets and better consumer advocacy opportunities. In 1999, the United States passed the Financial Modernization Act, which established a framework to permit affiliations among banks, security firms, and insurance companies. This bill, also known as Gramm-Leach-Bliley, continued the state's rights to regulate insurance, but also called for state regulation reforms to allow insurance companies to compete more efficiently to increase uniformity of legislation, licensing, and simplicity in access to marketplace. One of the important NAIC activities is the drafting and adoption of model laws and regulations, which are created by and voted on by the insurance regulators and insurance commissioners through a transparent, collaborative process. So the model laws are developed, industry and consumers are given the opportunity to provide input on the impact of the proposals. These model laws can take up to 2 years to go through the process of adoption as they continue to ask for consumer and industry input as each stage of the edits and amendments are made to them. These approved model laws then are recommended for each state to enact through their state legislators under the Division of Insurance or under the Division of Insurance Regulations. Model legislation helps provide carriers with improved uniformity of regulation to create efficiencies mandated by the Gramm-Leach Body Act and to strengthen consumer protections. There are also other organizations which create these types of model laws for insurance, including the National Council of State Insurance Legislators, or we know that as NCOIL, or the National Council of State Legislators, or NCSL. The NAC always reviews the models developed by these other organizations to look for ways to incorporate them into the models it is working on as well. Much of the Title 57 statutes, along with the applicable chapters of the Nevada Administrative Code, contain language developed throughout the years by the NAIC model language development process. The Nevada Legislature plays an important public policy role in the regulation of insurance, including proposing, debating, and amending insurance-related bills each session. Legislators provide the regulatory framework in which the department operates by establishing laws which grant the specific regulatory authority and the approval of our operating budgets. They also are very helpful in making appropriate changes where the state itself has a potential issue, like, for example, in our state gaming, where we want to make sure that either there's a carve-out necessary or that there's additional protections put in place. So insurance is a heavily regulated industry because of its potential risk and impact to consumers and businesses. State regulators perform quarterly and annual financial analysis on all licensed insurance companies each year, and they perform in-depth financial examinations of companies no less than once every 5 years to ascertain whether the carrier is in sound financial condition. Regulators from the state the insurance company is domiciled in are responsible for conducting these analyses and examinations. The results of the analysis and exams are shared and relied upon by the other members of the NAIC with information through these NAIC shared databases. The efficiency of the shared system of oversight has provided much greater cost controls to the carriers, which ultimately provides lower rates to the consumers while still maintaining solvency protections. Based upon the multiple insurance company insolvencies that occurred in the late 1980s and early 1990s, the National Association of Insurance Commissioners formed a special committee in 1988 to address inconsistencies with the state financial solvency practices for insurance companies. In June of 1989, the NAIC adopted the Financial Regulation Standards, which established a baseline for effective regulatory system in each state and subsequently became known as the Accreditation Standards. Under the accreditation program, each state's insurance department is reviewed by an independent review team that assesses the department's compliance with these accreditation standards. To provide for uniformity in training, proficiency, and standards among the state examiners, all NAIC state insurance regulators are subject to an accreditation process every 5 years. The NAIC performs a comprehensive audit and review to ensure the departments have adequate statutory and administrative authority to regulate an insurer's corporate and financial affairs, as well as the properly trained and effective staff and resources to carry out that authority. Nevada successfully completed its most recent accreditation review in 2017 and will undergo our next review in October of this year. In addition to the examination process, the NAIC accreditation standards also provide the impetus for the states to adopt in a consistent manner those NAIC model laws, regulations, and requirements that make up the U.S. insurance financial solvency framework. The standardization of these laws allow regulators from multi-states to rely on and accept examination reports prepared by other accredited state departments of insurance. As an example, during the 2021 session of the Nevada Legislature, the division's omnibus bill, AB 45, contained 2 accreditation required updates to our statutes. And this helped align Nevada law with a covered agreement that was recently signed between the United States, the European Union, and Great Britain. These changes to our statutes impact the reserving requirements for reinsurance that is purchased from a reinsurer based in the European Union or Great Britain. And this was based on originally the reason it came about is because Brexit caused this potential change in the way that the United States dealt with the European market, with the European Union versus the Great Britain issue. So in addition to the NAIC, Nevada is also a member of the Interstate Insurance Product Compact Commission. So this compact enhances the efficiency and effectiveness of the way insurance products are filed, reviewed, and approved, allowing consumers to have faster access to competitive insurance products. So the IIPRC, which is the commission, serves as the central point of electronic filing for certain insurance products. These include life insurance, annuities, disability income, and long-term care insurance to develop uniform product standards. And this affords a high level of protection to purchasers of these products. The compact has 47 compacting states signed on and over 100 adopted uniform standards. Nevada is the current chair of the audit committee for this particular commission. One of the roles of the Nevada Insurance Division is promulgating regulations that support statutes that are approved by the Nevada Legislature. The division currently has 5 regulations in process, as shown on this slide. So R15120 relates to stop loss insurance, which is a reinsurance that self-funded health plans purchase to cap losses to an employer. Stop loss insurance normally caps the dollar amount of losses per covered participant, and as well as the combined losses for all the participants. The division has been working with the industry and producers over the past several years to come up with revisions to NAIC 689B.350 and NAIC 689C.250. And we're hoping to provide the proper balance of making self-funded plans more available to smaller employers while providing necessary protections to employees, covered participants, and the fully insured and small group markets. After 2 recent workshops on R15120, the proposed regulation was sent back to the LCB for revisions just this January in 2022. R152-20 is updating the annuity suitability model, and that's found in the Administrative Code under Chapter 688A. So annuity is a tax-deferred product that includes both investment and insurance features and is primarily used by consumers to accumulate money. Annuities can also be annuitized, and this is where the accumulated value in the annuity can be converted into guaranteed payments, such as specific dollar amounts until the money runs out, or payments for a period of time, or what's called a certain period of time, which means 10 years, 20 years, whatever you determine, or level payments for the lifetime of the beneficiary. This product has sometimes been subject to sales abuses to consumers, especially to the senior population. And the Graham-Leach-Bliley bill includes the requirements that states update to the latest NAIC annuity suitability model to help ensure consumer protections. The latest version of the model includes the industry-supported standard of best interest, which is a term of art in determining suitability of annuity sales. After numerous discussions with the members of the industry, the most recent version of the proposed language from Nevada was sent to the LCB in January of 2022. So Regulation R153-20 relates to the business of bail and includes prohibiting certain acts by a person who does not hold the appropriate bail license. It clarifies that a bail licensee may not wear a uniform or badge which suggests or implies that the licensee is a peace officer or other member of a law enforcement or government agency. It also updates the continuing education and advertising requirements. The most recent revisions of this language to the proposed regulation was sent to the LCB on October of 2019. R154-20 has been received by the division, and we are actually preparing to send out notice of the first workshop. This regulation is an updated NAIC model regulation based on what we call Model 787. And its purpose is to establish uniform national standards governing reserve financial arrangements pertaining to certain life insurance policies. The financial requirements pertain to insurers that cede liabilities to reinsurer, and it applies to insurers that are domiciled in this state. The proposed regulations listed on slide the proposed regulation on the very bottom, listed on the slide still as AB 250, is still in the process of division internal review and has not yet been sent to the LCB for developing the initial agency proposed regulation. This regulation is intended to provide regulatory clarity for AB 250, which was sponsored by Chairwoman Howdy last session. And the bill itself provides for the opportunity for seniors to have an open enrollment period each year to shop for a new Medicare supplement plan during the month of their birthday. The regulation that we're working on is intended to provide clarity for insurers, producers, and consumers that the open enrollment shall apply to Nevada residents, even if they purchase their current plan in another state, and that policyholders will not be able to re-enroll with the same company with the same plan to go from a non-standard to a standard rate, and to clarify the commission limitations for replacing Medicare supplements in NAIC 687B.275 apply to replacements made during the birthday open enrollment period. And we've been working very closely with the industry on this particular regulation, which is why we're still in the drafting phase. So next I'm going to talk about the potential 2023 Bdr topics. And I'm going to spend some time highlighting some of these topics that we propose will most likely be contained in the division's 2023 BDRs. One of our potential BDRs will be centered on the associations of self-insured employers, which are also known as self-insured groups or SIGs. So the SIG statutes, which reside in NRS Chapter 616B, were added to the Nevada revised statutes in 1993, and the language remained mainly unchanged since that time. So SIGs are associations of self-insured public or private employers, which include private companies or government agencies to pool their workers' comp risks for their employees. So SIGs themselves have grown over the years as an alternative to commercial insurance for workers' compensation coverage in Nevada for small and medium-sized employers. And the statutory requirement for an employer to join a SIG is a tangible net worth of at least $500,000 or payroll during the previous 12 months that would have resulted in at least $15,000 of the workers' comp's annual premiums. These minimum employer requirements have remained unchanged since they were added to the statutes in 1995. So the reason we're focusing on this is because workers' compensation is very unique. So as statutorily, injured workers who are permanently disabled are paid their lost wages during the lifetime of the injured worker. Adequately reserving for these, what we call long tail claims, can create major challenges to provide sufficient assessments to cover both the claims that are owed today and for those that will be paid long into the future. The state of Nevada privatized workers' comp coverage during the 2001 session of the Nevada Legislature. And prior to that, the state provided coverage for injured workers through the State Industrial Insurance System, or SIS. In 1992, the state ordered an audit of SIS by KPMG Pete Marwick, and due to the challenges of reserving for these long tail claims, they concluded that SIS had a $2.2 billion of unfunded liabilities. And without a large increase in premium rates to employers or major changes to the state law, the fund would be unable to pay claims in less than 4 years. So over the next several sessions post that determination, the Nevada Legislature passed several bills to help shore up the state industrial insurance system. And after the 2001 session, they moved the liabilities from the state to private insurers. So under the current Nevada statute, SIGs are not financially regulated by the Division of Insurance the same way that private insurance companies are. For example, by statute, SIGs are not considered insolvent unless they cannot meet their current obligations, regardless of the amount of their unfunded liabilities for these long-term claims. They are only required to pay today's bills, but the liability could be for payments to an injured worker could last the rest of that worker's life. So traditional insurance are considered insolvent under NRS 696B.110, subsection 2, if their assets do not at least equal the sum of their liabilities, including its paid-in capital stock account, and they maintain the minimum required surplus. That means that they must have enough money to cover both short-term and long-term liabilities. In addition, insolvent worker compensation claims in the traditional market are covered by the state's Insurance Guarantee Association. And the Guarantee Association does not cover the claims of insolvent SIGs. To provide some perspective on the current size of the 7 active Nevada Association of Self-Insured Employers, the combined loss ratio, which represents the projected amount of liabilities that are owed to injured workers for both known and unknown incurred claims, currently exceeds $125 million, and their combined average annual cost of incurred claims exceeds $42 million. Employers that join a SIG must execute an indemnity agreement, which jointly and severally, this is a hard word for me, it independently and jointly binds them, each member, to secure all compensation that is due by that SIG. In addition, under NRS 616B.443, this liability extends to claims against any one insolvent association licensed in Nevada, regardless of the SIG you belong to. This basically means if one SIG goes down, then all members of the other SIGs must pay the claims going forward. Because of the growth of the Nevada SIGs and the importance of SIG financial security to Nevada's injured worker and Nevada's small and medium-sized member businesses, SIG financial solvency and reporting requirements is a topic that may be included in the upcoming BDRs. And if so, we look forward to an open dialogue with the legislature and the SIGs about needed reforms. And while we expect that the division will also have an omnibus bill, we are, I don't know if we're proud or happy to say, but we believe it'll be the smallest in size that it has been in numerous sessions. And we expect that actually might be well received by our LCB drafters. So the expectation is to propose language that is intended to correct errors, clarify statutory language that is either unclear or creates unintended consequences, and adds some appropriate regulatory oversight of insurers and licensees to ensure Nevada's insurance consumers are properly protected. Our proposed bill is expected to contain updates to one National Association of Insurance Commissioners model law. Some topics the division omnibus bill may include are administrator licenses, which are found under NRS Chapter 683. And the hope is to clarify that pharmacy benefit managers managing formularies for Nevada health plans must be licensed as third-party administrators, and also requiring notice of changes to legal or fictitious names. And we're also looking to require applicants for a Nevada administrator license to provide a copy of their license from their state of domicile, as well as providing a copy of any of their insurer agreements. We're looking at clarifying the term associations and appointments. The two terms associations and appointments seem to be used in the chapters interchangeably, but they actually mean two different things. So we want to help clarify that for the industry. And we're also looking at allowing for a request of an extension of a time regarding temporary licenses. And this is to help those folks who find themselves in the state issues after the death of a licensee, or to help out service members who are serving military tours of duty. And it allows them to request a continuation of their temporary license beyond the current 180-day limit. We are also looking at removing a potential loophole in the insurance statutes by limiting a health carrier's ability to remove a drug from the formulary and then add it back at a higher tier during the same plan year. And we are considering an update to the Naic annuity model law, currently Nevada law, which will allow for the sale of contingent deferred annuities, which is a type of annuity that is not designed to accumulate value, but actually guarantees a lifetime income payments if an investment account is exhausted during the life of the annuitant. And we're also considering updating the minimum allowed rate to determine the annuity non-forfeiture benefits. Our potential topics are also looking to address items such as clarifying bail enforcement agents' authority and adding protective measures to ensure bail enforcement agents, as well as consumer safety, making changes regarding confidentiality in 679B.190. This would include the staff deliberation of documents and information that results in an informal action by the commissioner, I apologize. And the 679B.190 confidentiality provisions related to captive insurers. We're also looking at changing the filing date of captive insurer reports of financial condition to match the date of their other annual required filings to make it easier on the industry. So as part of our discussion here, Chairman Howdiggy, I need a big breath. Chairman Howdiggy asked that I also spend a few minutes this morning discussing some of the other insurance divisions and insurance issues the division and the NAIC may be currently working with. So bigger picture, throughout the world, the insurance industry has seen increases in both the frequency and severity of catastrophic losses in recent years. And according to Munich Re, catastrophic losses exceeded $210 billion in 2020 compared to $166 billion in 2019. Insured losses during that period totaled $82 billion compared to $57 billion in 2019. And in some areas of the country, catastrophic losses have greatly impacted both the availability and the cost of insurance. So the NAIC has formed a climate and resiliency task force, of which I currently serve as the vice chair on the committee. A few of the topics that the task force are evaluating are the potential solvency impact of insurers' exposures, including both underwriting and investments to climate-related risks, how to apply technology innovation to the mitigation of storm, wildfire, and other climate risks, as well as earthquake, insurance product innovation directed at reducing, managing, and mitigating climate risk and closing protection gaps, and identifying sustainability, resilience, and mitigation issues and solutions related to the insurance industry and the role of state insurance regulators in resiliency. The Nevada Legislature's Natural Resources Committee has been addressing the issues of wildfire risk, which is the predominant catastrophic risk impacting the western states in recent years. But wildfires have certainly been knocking on our doors in northern Nevada for the past 5 years. Thus far, our state has fortunately had limited property damage due to the impact of these wildfires. Unfortunately, the exposure to wildfires has started to impact, though, both the cost and availability of property insurance to residents and businesses in now the brush and forested areas. So AB 100 from the 2021 Nevada Legislature was a bill related to wildfire risk, and Section 9 of the bill authorized the Commissioner of Insurance to create a program for insurers to provide incentives to promote and encourage property owners to take measures to mitigate the risk of property loss or damage caused by wildfire. The Division of Insurance has been studying this issue and held a wildfire mitigation incentive discussion on December 15th of last year. The discussion included presenters that were from the state foresters, that included the fire warden, the chief of a Lake Tahoe fire station, and members of the property casualty insurance industry, as well as Nevada insurance producers. The discussions centered around encouraging risk mitigation measures at the level of communities as well as individual properties, and looking at potential insurance carry incentives for more fire resilient and fire resistant home construction, defensible space mitigation issues and efforts, and technologies that can assist with fire suppression, such as roof sprinkler systems and fire retardant kits. So the division is currently continuing to research and discuss the issues surrounding wildfire mitigation incentives, and we'll be addressing this topic at the May 19th meeting of the Commissioner's Property and Casualty Advisory Committee. The last emerging issue I will briefly address this morning is the NAIC's committee. It's called the Special Committee on Race and Insurance, which I serve on. Some of the issues this special committee is looking into include race, diversity, and inclusion in access to the insurance sector and insurance products, as well as practices within the insurance sector that potentially disadvantage people of color and/or historically underrepresented groups. The committee will be looking at numerous issues regarding rates, accessibility, and outcomes, and this will include the impact of traditional life insurance underwriting or traditionally underserved populations, considering the relationship between mortality risk and the disparate impact. Disparities in the number of cancellations or rescissions among minority policyholders, and the examination of the use of network adequacy and provider network measures, such as provider diversity, language, and cultural competence to provide adequate and equitable access to cultural competent care. The committee will also be developing analytical and regulatory tools to assist state insurance regulators in defining, identifying, and addressing unfair discrimination in property casualty insurance, including issues related to rating and underwriting variables, such as socioeconomic variables and criminal history. This also includes potential bias in underlying data and the proper use of third-party data. The use of credit scoring, which is allowed in Nevada statutes for developing rates for property and casualty insurance, will also be included in the committee's discussions on the NAIC level. So this concludes my prepared remarks, and I'm happy to answer any questions you might have.
Thank you, Commissioner. I am going to go to the committee first to see if the committee has any questions. I will start with Senator Settlemeyer.
Thank you, Madam Chair. I was curious, a lot of the state departments right now, we have unfortunately some vacancies. So what's your current vacancy rate for your department?
Currently 32%.
Okay. Does that fall within the accreditation standards for NAIC, or are we in a problem with compliance there?
So for the record, this is Barbara Richardson. I'm just going to go through the formal. So we're actually using some of our staff in alternate ways. We happen to have some very highly talented actuarial students, and they've been helping out with our accreditation model. So we are currently in standard, but so close that it's breathtaking.
Okay. Are we in any trouble with any of the other accreditation standards for examinations or anything else of that nature?
No.
So we're in compliance, so are we not in probation with NAIC in any way, shape, or form?
No, we're not. Oh, I apologize. At this point, we actually are in probation, but that has nothing to do with the amount of people we have.
What does that do to?
That was due to a change. We actually had a change in our chief over a time period. So during that time period, the cleanup put us in a probation period because they always look at those kind of issues to make sure that there's a chief in play. And we currently have a chief in play.
Okay, appreciate that. What signatures you had indicated that you had reached out to them? What signatures have you reached out to? Do you have monthly, quarterly meetings with all the signatures, or which ones are you reaching out to?
I apologize. Are you talking about the SIGs?
Correct.
Okay, sorry. I just want to make sure I got. So we actually reached out to all the SIGs. We spoke to them at the last legislative session, and I personally reached out to all of them, and was invited in to speak with several of the boards, and I gave them information about what we're doing, why we're doing it, where we're going, and then we had several boards who declined to have me come and present to them.
So the last time the meeting then was during the last legislative session, which was a little while ago.
No, the last meeting was actually last summer. Was the last board meeting I attended.
Okay. Last question, if I could, Madam Chair. Have we lost any carriers in the state of Nevada? And if so, is it a big one or a little one? Why did they choose to leave? Are we having problems with retention of carriers in the state of Nevada? Because I hear from constituents from time to time, insurance problems. I was just kind of curious about that.
No, we haven't had any large movements. We've had some captive movements, but those would affect a particular company who altered their captive structure. We haven't had any insurance carriers who left. I think what we have been seeing, which is probably what you might be hearing, is that there's a slight bit of hardening of the market, especially with home insurance. Because of the wildfire disasters, we had some carriers who were concerned about writing in areas if there wasn't enough other insurance carriers to share the burden. But we haven't had them leave.
Appreciate it. Thank you for all the information. I'm concerned about the fact that we're in probation, so hopefully that gets resolved very quickly because the danger to the industry is just so great. If the Nevada loses that accreditation from NAIC, then all these carriers would have to leave. We'd have to be getting our insurance from other states, and I find that very problematic. So thank you. Thank you, Madam Chair.
Thank you, Senator. Members, any other questions before? I have a few, but I want to give members the opportunity first. Anyone on Zoom? Okay, Commissioner, I do have a couple of questions, and thank you, Senator. You actually asked one of mine, but then you've just created another one for me. This probation period, Commissioner, what does that mean? How long does it last? Because you did say we are in compliance now, so why are we currently still in probation?
Because probation will last until we finish our full evaluation, which is in October, which is the normal time we have our full evaluation. It's just the way they work.
Okay, thank you. And then I do have a couple of questions from the slides. On one of the slides, the one that showing the total direct premium written in state, and it was showing about 20 million. Does that mean that there's premiums written out of state? And if so, do you have a number of how much premiums that we're losing to other states? And is there anything we can do to attract that back into Nevada? Because I'm assuming that's a revenue loss for us.
So it's not premium, and that's how much the Nevada consumers are buying. It's not a loss to the other states.
Okay, no, correct. But we're buying $20 million worth of insurance in state, but is there a pool of insurance that we're buying out of state?
You can't sell insurance unless you have a license to sell in the state. So no, it's in the state.
Okay, perfect. Thank you. And then I did have, Senator asked my questions about the vacancies, but I did have another question for you as well. Let me get to my. And I wanted to ask some questions just related through the COVID period. Did your office see any increase or decrease in the amount of consumer inquiries to your office during that time period, whether it was like health insurance, like complaints or property and casualty?
So to be honest with you, no, we did not see an increase. We expected it, but we didn't see an increase in any of the complaints and inquiries, and we were able to handle them with the staff that we had.
Did you see a decrease?
No, it stayed pretty steady. The only thing that we saw decrease is like the other state agencies, we didn't have people coming in the door, but we had a lot, the market just switched and they started using the online services that were available.
Okay. And then you also touched a little bit on licensing, and you said it may be making it easier for service members, but can you talk to me a little bit about the licensing process for health and then for P&C? If someone comes in from another state to Nevada, do we have a reciprocity process, or can you explain how that works and how easy we make it for people to come in and practice in our state?
Certainly. So yes, Nevada is reciprocal with the other states. Okay. So if you have a license in another state and you want to sell in Nevada, you apply just like anybody else, and you apply online, and there's 5 different criteria that you have to get through. But all of those can be shown to be valid by checking at the home state, which is what we do. We get the information from the home state. So basically, to be somebody from Idaho or Iowa, if they want to sell in Nevada, they would apply online and get all that information because we're reciprocal. If there's a problem, we go to the home state and talk to them about it. So if you have your license in another state, the speed to get licensed in Nevada is quite fast because we're not doing all the secondary looks like the other states are doing for their own home folks, that explains why we have 220,000 licensees.
How quick is that process? So if someone submits an application for a license in Nevada, because we are a reciprocal state, how quickly do they get their license? And are they required to be a part of a company that has a brick and mortar shop in Nevada, or they can just be like an online carrier and sell insurance here?
So if you're talking about a carriers take a long time because no matter what, we check their solvency. If you're talking about licenses for producers or salespeople, then that's very fast. And if you're talking about carriers, that can take anywhere between 90 to 180 days, depending on how ready the carrier is to come in the door. Because we also need to make sure, for example, a company can be perfectly fine in its home state, but it needs a statutory deposit to be in our state, and they have to come up with that funds as well. So sometimes it takes them a little bit longer to get in the door, but it's mainly just to sort of cross the threshold for consumer protections.
And then just for like an individual producer?
That shouldn't take more than 48 hours unless there's some kind of hiccup on their record.
Okay, thank you. And then I just had one last question regarding the SIGs. You did say that they were increasing in popularity. Do you have any indication as to why, like what's causing the increase from like leaving the private side into the SIG side?
So that happened quite a while ago. So I think the popularity is the same reason why folks move to any kind of self-insured is they want control of their own destiny, which is perfectly reasonable. I mean, you want to support that kind of move. You just want to make sure though that in the long run that they can pay their long-term bills. So And it's not a problem. We've seen states go different directions. As a matter of fact, we did have one of the SIGs who decided that they weren't going to be going in that direction anymore, and they moved back into the regular market. And I would suggest that years ago, the cost of workers' compensation was much higher, and in the regulated market, and it has gone down every year significantly for the past 8 years. So now the prices are coming more in line. So we should see some stabilization in that move.
Thank you, Madam Chair. How you doing, Commissioner? I just had a couple of questions, and I just got caught the last portion of it. You were talking about cultural competency and talking about some of the ways in which you all look at that for training, et cetera, et cetera. So my question is this. We know that there are some neighborhoods, although, quote, redlining doesn't exist, it does exist. And I want to know, are you all doing anything, or is there any program available that would be able to show you some inconsistencies in terms of how some properties, some neighborhoods, some businesses, small businesses, or what have you, are either receiving the proper level of insurance for the accurate price or not?
So yes, as an organization, that's one of the data points that we're requesting, because what we're trying to do is find out if they're getting redlined by zip code, if they're getting redlined by neighborhood, if other issues are creating the red line factor. I mean, are there actually risk issues that are causing it? So yes, all of those things are being looked at. And one of the issues that we're looking at now is something that Colorado has already put forward, and it's called Algorithmic Auditing. So it looks for a discrimination that is illegal versus discrimination that might be okay. So there are allowances for discrimination and risks in general for insurance, because different people have different risk profiles. However, there are some types of discrimination which are illegal. So that's what algorithmic auditing is trying to do, is peel apart those that are reasonable because it's an underlying risk issue versus those that are based on something that would be improper.
So if an insurer is found to be guilty of that, what, if any, are the consequences? And are those consequences published? And I'm looking for a way that we can talk about deterrence, because it's these types of prices that are hidden cost to BIPOC communities, and that also minimizes their opportunity to go from where they are to grow to where they want to be.
And I appreciate where you're going. I think that the National Association of Insurance Commissioners is going the same place. I just don't think they have all the data yet to be making those kind of calls. So that's where we're starting from right now. And we've been starting to gather data, but just not quite there yet. So I don't want to say what the consequences are, because ultimately that would be up to you as legislators to determine what the consequences would be if we found such an issue in an insurance carrier.
Thank you, Vice Chair. Okay, members, last call. Those on Zoom? Thank you so much, Commissioner, for being here. We appreciate your presentation. Okay, committee members, our next agenda item number 5, is a presentation by the Nevada's Patient Protection Commission of the Department of Health and Human Services and the Cost Growth Benchmark. The Patient Protection Commission was established in 2019 by the legislature to systematically review healthcare needs of Nevada's citizens and the accessibility, affordability, and quality of healthcare. The commission also reviews the disparity of care among different communities, including the availability of health insurance plans. I believe we have Ms. Southard here to present.
Hi, good
And I
morning.
believe we have her on Zoom.
Sorry, I'm here in Carson, City. Good morning.
Hi, good morning, Ms. Southard. When you're ready, the floor is yours.
Excellent. My slideshow is not running. I apologize.
You're okay. Take your time.
I apologize for that. Good morning, Madam Chair and members of the committee. Thank you for having me here today. My name is Melinda Southard, and I am the newly appointed Executive Director for the Patient Protection Commission. And I've been in this position for about a month, so please bear with me. Today, I will be giving you an overview of the Patient Protection Commission, or PPC, as well as the priority focus of the PPC over the past year, the Healthcare Cost Growth Benchmark. First, a little legislative history. The PPC was initially created by SB 544 in 2019. This bill was sponsored by the governor and approved by the Nevada State Legislature and was codified to NRS Chapter 439. In 2021, changes to the PPC were proposed and ultimately approved with AB 348. This bill changed the Commission's members, added responsibilities and topics for review assigned to the PPC, moved the PPC from the Governor's Office to the Department of Health and Human Services, required the PPC to adopt bylaws, and designated the PPC as the sole state agency responsible for managing Nevada's participation in the Peterson-Milbank Program for Sustainable Healthcare Costs. And I'll talk a little bit more about that later. The current makeup of the PPC is as follows. As you can see, we have quite a variety of organizations, patient advocates, and viewpoints. We also have 4 ex officio non-voting members of the Commission. As noted in NRS, the PPC is charged with systematically reviewing issues related to the healthcare needs of residents of Nevada and the quality, accessibility, and affordability of healthcare, including prescription drugs. Most notably, for our current focus, this review includes examining the cost of healthcare and the primary factors impacting those costs. In March of 2021, Nevada was selected to participate in the Peterson-Milbank Program for Sustainable Healthcare Costs. This allowed us to receive technical assistance from the Milbank Memorial Fund and Baylor Health as we work to set and implement healthcare cost growth benchmarks. This is one of the first steps in helping to make healthcare more affordable and transparent in Nevada. To support this statewide effort with Peterson-Milbank, Governor Sisolak requested assistance of the PPC to provide recommendations to develop a statewide healthcare cost growth benchmark, calculate and analyze statewide healthcare cost growth, and analyze drivers of healthcare cost growth. Per this request, the PPC has been hard at work with Peterson-Milbank and Baylor Health to be able to provide those 3 recommendations to the governor. So, what is a healthcare cost growth benchmark? Here's the official definition, being an annual rate of growth benchmark for healthcare costs for a given state. I also provided some national statistics here, so you can see between 2015 and 2019, the average per capita healthcare cost growth was 4.1%. For those same years, the per capita GDP, or measure of a state's business growth, was only 3.5%, and the average hourly wage growth was only 2.6%. So between 2015 and 2019, healthcare expenditures grew faster than businesses were growing and faster than wages were growing. Some key points to keep in mind about a healthcare cost growth benchmark are that setting a public benchmark for healthcare spending growth alone will not slow the rate of growth. A cost growth benchmark serves as an anchor, establishing an expectation that can serve as the basis for transparency at the state, insurer, and provider levels. The cost growth benchmark is a support strategy to help ensure costs don't rise faster than the economy, state revenues, or wages. To be effective, it must be complemented by supporting strategies. Additionally, a cost growth benchmark is not a price control. Here, I'd like to share with you the logic model associated with explaining what a cost growth benchmark is. So we'll start with measuring. We have to first measure performance relative to the anchor or the benchmark. Next, we analyze. Okay, we see that our performance either falls above or below the benchmark for a given year. Now let's do a deeper dive into that data to find out why. What specific factors relative to healthcare costs are driving those costs higher or lower in a given category? After the analysis is complete, we then report on the findings. Here's what we found out as to what specific factors are driving up healthcare costs in the state. It is also important to note here that the findings will be shared with the healthcare industry prior to being publicly released, so the industry can additionally validate the findings for accuracy and be well poised for a public release of the report. After reporting out on the analysis, we would then have conversations with healthcare industry experts in Nevada to identify those opportunities and potential strategies to help slow healthcare cost growth in the state. Lastly, of course, we work together with our partners to implement those cost growth strategies. In December of 2021, the governor issued Executive Order Number 2021-29, which is the Nevada Healthcare Cost Growth Benchmark. This executive order established the healthcare cost growth benchmark for years 2022 through 2026. This set a benchmark of 3.19% cost growth for the year 2022 when compared to prior year spend. The intent, of course, is to help curb those climbing healthcare costs. Some recent PPC activities with regard to the cost growth benchmark are highlighted in this slightly busy slide. The PPC had requested analysis of state Medicaid and the Public Employee Benefits Plan, or PEB, healthcare spending data as a proxy for the commercial market for years 2016 through 2020. This data was just recently presented at our monthly PPC meeting on April 20th. Our cost growth benchmark program will assess healthcare cost growth for all Nevada residents with commercial, both insured and self-insured, Medicaid and Medicare coverage, or who receive healthcare through the Veterans Health Administration and the state correctional system. We also aim to include spending for Nevada residents who receive care through the Indian Health Service in an effort to make our cost growth benchmark analysis as comprehensive as possible. Healthcare cost growth at the state level is measured using total healthcare expenditures, which includes claims spending, non-claims-based spending, consumer cost sharing, and insurer administrative costs. It is really meant to be an all-inclusive look at healthcare expenditures. So, what's our timeline look like for Nevada's benchmark analysis? As you can see, this May, we intend to formally request baseline data from all Nevada insurers and hold trainings outlining the request. We are requesting the baseline data from insurers by the end of this August to then be able to validate, analyze, and review that against baseline benchmark findings with the PPC and stakeholders by winter of 2023. Again, we will be communicating with the insurers prior to analyzing the data with the PPC so the insurers can additionally validate the findings for accuracy and be well poised for public release of the data. Further, the timeline for potential policy initiatives is outlined here. By the end of May, the PPC is planning to make a decision on what 3 bills to draft for the 2023 legislative session. And by the end of July, the PPC is planning to vote on and submit 3 bill draft requests for the 2023 session. And that concludes my slideshow. I'll stand by for questions.
Thank you so much. I actually was writing down questions and you were answering them as you were going through your PowerPoint, so thank you. I'm going to go to the committee members first to see if there's any questions here. Vice Chair, I'll start with Vice Chair.
Thank you, Madam Chair. So just a couple of quick questions and welcome. I hope you're enjoying yourself. And it's everything that you wanted it to be, that's good, and nothing that you didn't want it to be, that's not so good. This is a rather new committee or entity. So my question would be, what does the committee makeup look like demographically?
Demographically, we have a wide variety of members. I've been meeting with each of them individually lately to get to know them a little bit better, and I can tell you that we do have a wide variety, and it's not one silo.
Can you just give me examples, wide variety? Are we talking about culture as in ethnicity, culture as in language, cultural as in differently abled? What does that look like? What does wide variety look like?
Sure, I apologize. I would say we have members that were born in another country and not in America. We have members that have come from different socioeconomic backgrounds, and we have members that are in different geographic areas of the state, both rural and urban members.
Follow up? Yeah, and I ask that question because I think it's very important. One of the things that was lacking during COVID was a wide range of diversity with respect to providers and then connection with the some of the programs that were supposed to be there for people, specifically for BIPOC communities. And since we do know that racism is a public health crisis, that seems to center in on patient protection because the level, and I won't say of competency, but the level of care and treatment for people in different ethnicities varies. Not just from, north to south, but varies. Typically, I just heard from a mother last night who buried her daughter last year because the people weren't doing for her what she should have been done. So having different people from different backgrounds, different ethnic backgrounds, and differently abled backgrounds lends an eye and an ear, if you will, to make sure that the provisions that are supposed to be outlined, the legislative intent for that bill, make sure that they are moving forward. And so I'm always asking that question. Nevada is becoming a more and more diverse state, and Southern Nevada is probably becoming more and more diverse as well. So I'm always considering that.
Thank you.
Thank you. And actually, I'm going to just ask one question. I saw that there was a vacancy for your 12th member. How long has that seat been vacant for? And do you guys have someone already in line to fill the seat?
Sure. So that seat has been vacant for about a month, I would say. And we do have somebody outlined for that seat. Thanks.
Okay, thank you, Ms. Southard. I'm going to go to the committee for a last call. Okay, those on Zoom? BPS, if we could just pan out so I could see those on Zoom just to see if they have their hands up. Okay, members on Zoom, I can't see you, so if you have questions, just jump in. Okay, thank you, Ms. Southard, and congratulations on your role. It looks like that's all we have for you. Thank you.
Thank you very much.
Thank you very much. Okay, committee members, that moves us on to agenda item number 6. We have Mark Kruger here, who's the Chief Deputy Attorney General and Consumer Counsel with the Office of the Attorney General. He will make a presentation on the enforcement authority of the Bureau of Consumer Protection of the Attorney General's Office over the Unfair Trade Practices Act, with an emphasis on mergers and acquisitions in healthcare markets. For those of you who sat on Commerce and Labor last session, you would know that this was a big topic of discussion, and we had some bills come our way dealing with this. Mr. Kruger, thank you so much for being here. When you're ready, please begin.
Thank you, Chair Howdigi. Members of the committee, my name for the record is Mark Kruger. I am a Chief Deputy Attorney General in the Nevada Attorney General's Office, Bureau of Consumer Protection. Thank you for having me here today, and I will hopefully answer all of your questions, but no doubt may not be able to, but we'll try. Let's go over quickly. The Bureau of Consumer Protection does a number of things. However, one of the important things we do is we enforce the Nevada's Unfair Trade Practices Act, which is an antitrust, essentially, provision. The statutory authority of the Unfair Trade Practices Act is found under 598A 070 subparagraph 1. Basically, we also look and work often in conjunction with our federal partners to enforce antitrust violations, both for state law and with our federal partners looking at federal law. Types of claims for relief are available to the Attorney General for violations of antitrust law. I have several slides that might be a little bit thinner, but I think you have handouts. If you haven't gotten them, please just ask me to go ahead and read it out to you. But the statutory authority is found, and this provision is the statutory authority under 598A. It allows the Attorney General and requires the Attorney General's office to enforce provisions of the chapter, investigate suspected violations of provisions of the chapter, and then, of course, we have the authority to institute proceedings on behalf of the state or its agencies or political subdivisions. For purposes of gaining injunctive relief to prevent and restrain violations of restraint of trade, civil penalties for violations of this chapter, and there is a provision that allows us to look at criminal penalties for violations. Then we also have equitable relief violations. I'll get into some of that a little bit as we go down. It's important to note that the Attorney General's office has parens patriae authority. Parens patriae standing is asserted whenever a state claim is of injury to a quasi-sovereign interest as the well-being of its populace. That is, we represent the people. And that's been well defined within different court decisions, and I've listed one here. Injury must be sustained and generalized and not simply an injury to a limited class of citizens. So there's a couple cases that also support that parens patriae authority for asserting injunctive relief to prevent, for example, a hospital merger. Because we're emphasizing healthcare markets, we thought a few of these cases might be helpful to the committee. So for tools and resources for investigation by the Attorney General's office, we actually cooperate and coordinate antitrust enforcement with other states. Often we call this a multi-state actions. But we also work with the Federal Trade Commission and the U.S. Department of Justice, who also do a lot of federal antitrust work. Our primary tool for investigations begins with a civil investigatory demand. That is basically a subpoena that we have authority under our statute to issue to gather documents and information in order to investigate and determine whether or not there's violations of the chapter. Any 598A 110 provides any materials and information our office receives in response to the civil investigation demand is confidential. That is an important piece of this. We want to be able to make sure that companies are giving us everything, and if particular information is given us just that's very sensitive to the market, we obviously don't want that to become public and disrupt the market. Okay, so going into a few harms, examples of substantial and generalized harms. Price fixing in a pharmaceutical case. This is an ongoing case, so I can't go into a lot of detail about it, but it's being litigated through several states. Nevada is a participating state in that. It is basically looking at price fixing or allegations of price fixing with generic drugs. This does not include opioids. I just wanted to make sure that was clear, that I get that question a bit. But we've also reviewed mergers and acquisition in healthcare and health insurance. And a lot of times I think people don't know about the fact that we're out there doing this, but we're heavily involved in it. So, for example, we look at consolidation of hospital services may achieve cost savings through economies of scale. Such cost savings do not always accrue to the consumers. We want to make sure that those cost savings do. Hospital mergers have not always been demonstrated to improve quality of care, access, and cost. In some instances, concentration in the market for hospital services has been found to increase inpatient services. So these are the types of things that we're looking at to make sure that we can keep those costs down. Some other additional generalized and substantial harm is price fixing effect of a hospital consolidation. This can be magnified in geographic markets which already consolidated and could result in price increases. Horizontal consolidation of physician practices has at times been found to be associated with increase in price for physician services. And I should also say that we also look at vertical consolidation as well. Monopoly power exercised over independent provider practice groups by dominant health insurers can result in a compromise of the quantity and quality of care. These are all in the health market, what we are looking at to prevent through our investigations. Also, the federal law as well as state law prohibits agreements and restraint of trade, monopolization or attempted monopolization, and mergers, acquisitions are reviewed for these particular things. All right, antitrust violations are enumerated in our law. They obviously go with price fixing. I gave you an example of the generic drugs litigation that we're looking into those allegations. Division of markets, allocation of customers, tying arrangements, monopolization or attempted monopolization, and antitrust reviews and mergers of acquisitions. Typical types of unlawful conduct in healthcare under S-598A, and this is really specific to healthcare, what we really look at, and that is obviously monopolization, tying arrangements, allocation of customers, or agreements among competitors to restrict the volume of production. And we're talking about the ability for practitioners to be out there and be competitive in the market. Additional conduct in the following types of contracts and clauses are often what we look at here. And these clauses come up a lot of times with purchase of healthcare practitioners by, for example, larger groups or insurance carriers. We look out for anti-steering clauses, anti-tiering clauses, and then tying agreements, arrangements, and exclusive contracts. Some of these examples I went over a little bit earlier, and I'll go over again. The generic pharmaceuticals and antitrust litigation is allegations of price fixing. We've talked about that. Joint merger review with the Department of Justice resulting in an independent consent decree with the Nevada Attorney General's office. That was with the United Health Group and a health insurance merger review. We've also done a joint merger review with the FTC or the DOJ resulting in federal agency consent decrees. And those particular ones for the matter of Renown Health, and that was a consent decree some time ago concerning the acquisition of a cardiology practice. That has been monitored for several years and has done well. Following that, we've also had a consent decree involving managed care provider organizations which provide primary care physicians and specialists to MA organizations. We've also done some in-state review and investigation of mergers, acquisitions, and healthcare insurance transactions. This is really important because we, through the help of this committee, passed AB 47 last session, which allows us to get notification. We've developed our forms that are required under AB 47 and are pleased to let you know that it's working very, very well. We're receiving the formal notifications. In addition to that, we are actively involved in the National Association of Attorneys General's multi-state working groups. We have several of them that we're involved in, which continually monitor particular areas for any kind of violations of federal or state laws with regard to unfair trade practices. We do a lot of work also submitting briefs, amicus briefs on litigation that is finding its way up through the courts. And then finally, we evaluate whether potential anti-competitive conduct by a state agency qualifies for state action immunity, and there's a specific citation for that. So, what happens if we find violations? Well, we have the ability to seek damages. We also have the ability to seek enforcement actions, such as injunctive relief. We want to prevent and fix, as well as impose civil or, as I said earlier, criminal penalties. And then we have some equitable remedies, which we're pleased to have been incorporated through AB 47 as well, which allow for disgorgement and restitution. So Injunctive relief, typical horizontal merger review and a consent decree is how we normally look for injunctive relief. Example, the United Health Group, which we talked about earlier. A common injunctive remedy is to require divestiture of a good or service to an independent third party to maintain a competitive market. Sometimes it doesn't require, when there's a merger, a divestiture of an entire unit. It could just be like a certain portion of a practice needs to be divested, and that's what we saw in healthcare in the United Health Group merger. Reparative injunction prevent future harms and effects of past acts, particularly when they violate the Clayton Act or a parallel Nevada statute. For example, in this particular case, we are actively involved in New York versus Facebook, which is a multi-state case. We also have some other examples here: California and American Stores Company and Stevens and Sons Inc. I left the citations in there in case you want to read on them. I don't have the information on them on the top of my head, so if you're inclined to ask questions, I'll have to defer to some of my experts or get back to you. A common injunctive remedy is to require the implementation of an antitrust compliance program. And as you can tell from this whole entire slide and my testimony here today, that it's not always about finding damages. It's about finding injunctive relief to get somebody into the right track and prevent the non-competitive harm that's occurring in the marketplace. So injunctive relief can be more severe, though, and that's one of the reasons by setting aside mergers or acquisitions, that's why we went ahead and sought the requirement under the law through AB 47 to get notifications of mergers, especially in the healthcare market, prior to the merger being consummated. That way we can address the concerns earlier. So everyone's happy, or happier, because it's not like you have to undo a transaction. We hope to get there before the transaction's completed. If the transaction, which is the source of the violation, involves a consumer or a violation of NRS 598, we do have enforcement of civil penalties up to $10,000. Also, failures under certain reporting requirements can be up to $1,000 under AB 47 a day. Civil penalties are forfeiture of charter rights or dissolution of domestic or foreign corporations. We can even look for a suspension or privileges to conduct business in Nevada. Obviously, that would be the remedy of last resort. We value our corporate residents and want them to also be actively engaged and have a robust market in Nevada. And then, of course, we have the ability to seek disgorgement of profits and or restitution for violations. And then finally, as I said, there is a criminal provision. So injunctive relief seeks to unwind or undo the consummation of the merger. I gave you some examples of that in a case here today. Again, as I said, the preferred remedies are to get out in front of it, and with the tools that this body through the legislature handed us through AB 47, we're really successfully finding that a review up front is working much better. But in any event, there's also other remedies available that are available to the Attorney General's office that actually aren't available to federal agencies. And we can look at disgorgement and restitution. There's some case law there as well. And as both hospitals and insurance companies seek to add large provider groups or specialty provider groups, vertical issues can also arise. I alluded to that earlier. For example, allowing an insurer to foreclose these providers from providing their services to rival insurers, anti-tiering, tying, and somewhat steering provision, or providing a hospital greater leverage to steer patients to their facilities, so requiring them to go to a different facility. It's important to review whether assertions of merger-specific efficiencies are likely, and that's why we find that the merger review and investigation up front helps to protect consumers by not allowing these types of activities to occur. And with that, I know whenever I get into antitrust, and the deeper we get into it, even my own staff, it can get a bit overwhelming at first. It's an extremely complicated area. I will do my best to endeavor to answer your questions, if you have any.
I know I have a question, but I'm going to go turn to our committee members first. I'm going to start with Vice Chair.
I don't know if it's that I'm just inquisitive or maybe I don't catch it all, but how you doing, Mr. Kruger? So I guess the first question I would have is when you start talking about antitrust and, people trying to limit the number of providers, how do you know if it's not hospitals, or how do you know? And I'm thinking specifically about, we've talked about in the past, some of our boards limiting the number of people who can come in or who get licensed. So how do you know?
That's an excellent question, Senator, and that was part of the problem prior to AB 47 is we weren't catching all of these mergers, and we were finding out after the fact. So with AB 47, the intent and what we're finding is that the notifications of the mergers and these change in acquisition or control are actually being provided to us pursuant to the law. Now we have the ability to review this up front and find out whether there will be an impact, exactly what you're describing. If something in the past had come to our attention, it usually was from a complaint by another provider or another or consumer or another organization, usually within the same market. So somebody would bring it to our attention, which could then trigger us to take a look and start an investigation. As I said, usually we start by issuing a CID.
Thank you. So I guess my follow-up, and I just want to drill down a little bit tighter. As people apply for licenses in whatever profession certification that they seek, as they provide for licenses, is there a way to tell if the granting or not granting of licenses is a way to keep the pool small and expand the profits? You understand what I'm saying?
I do understand your question, Senator, and that's an interesting question. I don't have an answer for you at the top of my head. I would surmise that there is a potential if you had some nefarious conduct in attempting to limit the number of providers by, say, a licensing board, then yeah, that could impact, and obviously would impact a market if it was done for some, as I said, nefarious reason, not a legitimate reason. On the flip side of that, if there was a limit on providers, hypothetically, for a legitimate reason, that could also impact a certain market area. And remember, we're not just looking at the market as Nevada as a whole. We look at geographic markets. We look at other, industry-specific markets. There's a lot of different markets that could potentially be impacted. So I don't have a specific answer to your question, but other than to say that hypothetically, yeah, it could be an impact, and that would be something that if someone had any concerns about, I would hope that they would bring it to our attention.
One last one. So the last one would be, we talked about hospitals. Is there anything in statute that looks at print media merger?
Print media merger?
Newspapers, consolidating into one, even TV stations.
So Senator, I'll answer that kind of in the reverse. There's nothing in this statute that specifically says, look at this type of industry, if you will. But what it does is, through the federal and state laws, is grants us the authority to look at all industries. So hypothetically, yeah, I mean, not even hypothetically, for sure, we could look at those different types of industries if there was a rise of concern that it was violating the Unfair Trade Practices Act.
Thank you, Vice Chair. Members, any other questions? Members on Zoom? Okay, I do have one question for you, and I'm not sure if you'll be able to answer it or not, but maybe I would say 2 months ago, received a call from someone in Northern Nevada because I chaired Commerce and Labor and AB 447 went through there that had a provision regarding not being able to restrict or to enforce non-compete clauses. There had been an issue in Reno with anesthesiologists, and so they had called me to see if AB 47 would be able to help in where all of the anesthesiologists were under a contract with one business, one company, and when they left, they were not allowed to go to any other place or provide any other services because they were enforcing the non-compete, which means that everybody in Reno had no access to an anesthesiologist, and so which means they had to bring in anesthesiologists from out of the area, right? Which again is going to cause prices to go up. And so is this something that AB 47 would have been able to, would address, or do we need to go further in the next legislative session so that we're not left in a situation where Nevadans don't have access to the health care that they need?
Chair Howdiggy, thank you for your question. I am aware of these series of transactions that resulted in what you've described. While I'm not at liberty to publicly discuss a lot of the detail, I can follow up a little bit with you after the meeting if you like, or at another time. But I will say that our office did look into this area, and the issues were resolved. So at this time they're resolved. So, but I think to your direct question, I think AB 47, the provisions that were provided in enhancing the Unfair Trade Practices Act as well as the non-compete clauses kind of commingle together and are helpful. So.
Oh, was this resolved as a direct result of AB 47?
I wouldn't say that. There was some independent litigation, and so it whether or not it's still pending. There might be some provisions still pending, but there is independent litigation that is before the district court.
If it hadn't been resolved on its own, would it have been resolved through AB 47? Would the mechanisms we put in place through AB 47 been able to have stepped in and?
To a degree, some of the enforcement provisions that I've talked about here today that were added to AB 47 could potentially have assisted, yes, the Attorney General's office.
Okay, thank you, Mr. Kruger. Committee members? Okay, I assumed it got resolved because when I followed up with them, I never heard back again. So, thank you. I'm going to check with members on Zoom. Any questions? Okay, thank you, Mr. Kruger. We appreciate you being here to answer our questions. Thank you. Okay, committee members, we are moving along, and we are now on agenda item number 7. Agenda item number 7 are presentations by the American Property Casualty Insurance Association and the Nevada Justice Association. I do want to let the committee members know, and those who are tuning in online, that we actually received notice there was some scheduling issues, and unfortunately the Nevada Justice Association can't be here to present today, but we still do have the American Property Casualty Insurance Association, and I believe we have Ms. Karen Collins. Ms. Karen Collins is the Assistant Vice President of Personal Lines Policy Research and International of the American Property Casualty Insurance Association, and she will be here to present on some of the needs of the industry. Ms. Collins, when you're ready, please turn on your screen and presentation, and the floor is yours.
Great, thank you. And I've gone ahead and launched the screen share. Are you able to see this okay?
Yes, we can see your PowerPoint just fine. Thank you.
Perfect. Yes, I'm Karen Collins. I'm the Assistant Vice President of Personal Lines with the American Property Casualty Insurance Association, or APCIA for short. Our organization is the primary national trade association for home, auto, and business insurers, and our goal is to promote and protect the viability of private competition for the benefit of consumers and insurers with a legacy that dates back 150 years. Briefly, our members, which are insurance companies, represent all sizes, structures, and regions, and offer insurance products and services that help protect families and businesses in the U.S. and also around the globe. One of the important contributions of our association provides us, we conduct and share research and analysis of trends and challenges in insurance companies and consumer space. And we will often examine these issues from a national and at times international perspectives, such as climate change impacts or supply chain constraints, and how these issues may affect the frequency and severity of loss events, including natural disasters in individual states, such as Nevada. My presentation today is going to focus on the trends affecting affordability of insurance and auto and home insurance lines specifically, such as inflation and supply chain issues, as well as some other trends leading to pressure on the availability of home insurance in some of our Western states, such as the climate change impacts and increased natural disasters. So let me start with inflation, which has been a top concern for our industry. A major wild card for the economy and really the broader insurance industry has been inflation. The Federal Reserve Board has indicated that the recent rise in inflation is transitory and will normalize as supply chain bottlenecks are resolved. However, the inflation rate for insurance inputs, such as the cost of new and used cars, auto parts, home construction materials, and construction labor, have been increasing much faster than the underlying consumer price index. Insurance cost inflation has been increasing faster than either premium increases or investment yields, which has really put some significant pressure on insurers. The number and cost of extreme weather events has also been increasing over the past several decades, and I will get into those on how climate impacts are also contributing overall inflation within property lines a little towards the end. But in March, inflation has hit a 40-year record, reaching 8.5% and climbing. Upward spikes in inflation are particularly pernicious to insurers because there's a time lag in forecasting and obtaining state approval for offsetting rate increases. High inflation means necessary rate increases are more likely to exceed state flex bands where those exist or run up against political resistance, particularly when they reach these higher single or double-digit values. Insurers are also, the risk is increasing over long tail exposures with inflation, as well as increasing risk exposures from climate change, cyber attacks, and higher home replacement costs. Insurance investments have been hit a little bit hard in 2022 with hundreds of billions pulled from money market and bond funds, while the Dow and NASDAQ equities indexes have also fallen in recent months. For auto insurance specifically, we recently published a research report that really digs into the headwinds that our auto insurers are facing. One of the biggest auto trends specifically has been the return of driving levels, following a brief dip in miles driven in 2020, which was at the beginning of the pandemic, as shown by this orange line on this chart. What you can see from the red line is that miles driven in 2021 were almost completely normalized, largely tracking the same patterns from 2019, the blue line. And this is consistent with a growing number of insurers which are reporting rising trends as drivers have returned to the roads, which typically corresponds with increased accident frequency. However, of higher concern is the cost to settle claims, which has risen significantly as insurance claims inflation in many cases has exceeded broader inflation, which is the dotted line. The top two lines in this graph, the blue and orange lines, represent the escalating cost of used cars and rental cars, which have spiked far higher than underlying inflation. Now, anyone who's tried to rent a car recently has probably noticed limited availability of rental cars or that the prices are much higher recently. When travel ceased with stay-at-home orders, rental companies in response sold many of their vehicles to help with cash flow, then planned to repurchase their fleets as needed. However, the demand for vehicles actually increased sharply during the pandemic as more people wanted to avoid mass transit or move out of cities. At the same time, the availability of computer chips used in cars dramatically contracted, with a shortage that has not been expected to begin easing until at least the third quarter of this year, with some recent reports indicating that could even stretch into 2023, if not beyond. This has created a shortage of new vehicles, which has in turn led to a sharp increase in demand for used cars. According to the Manheim Used Car Value Index, the price of a used car in February was up about 45% year over year. This has impacted rental companies, which have since struggled to replenish their fleets, and is why most people are now experiencing limited rentals and spikes in rental car rates as they look to rent a car for vacation or other business purposes. This combined shortage and rising cost of vehicles has also led to more people holding on to their vehicles longer, further contributing to auto repair costs. As actual cash values rise, vehicles that might normally be deemed a total loss may actually become more economical to repair. However, the trickle-down impact is the industry is now experiencing challenges from repair shop capacity. We are observing longer days from skilled labor shortages and lack of car parts needed to maintain and repair vehicles, whether due to a car accident or simply servicing your own vehicle. As it relates to an auto insurance claim, the average length of a car rental for collision replacement is now over 18 days, an increase of almost 5 full days compared to the first quarter of 2021. Now, these trends, along with ongoing inflation in medical care costs, and as I mentioned, the rebound in miles driven, are really the main culprits that have led to a sharp increase in auto loss results in 2021. In the chart on the left, you can see the third and fourth quarter loss ratios and personal passenger auto skyrocketed, ultimately hitting their highest levels in over a decade in 2021, with current trends expected to persist well above the 5-year recent average, which is the blue line. Moving to the chart on the right, this shows the overall personal auto loss ratio for the year reached 68.1, the second worst yearly result in a decade, which are the red bars. It was reported this week by S&P Market Intelligence that the auto industry as a whole did lose money in 2021 as the combined ratio climbed to a value over 100, specifically to 100.8%. Now, the homeowners loss ratio in 2021 was even higher than auto, unfortunately reaching 68.6, the gray bars. Also in this chart, you can see the homeowners loss ratios in the last 5 years, so looking at 2017 to 2021, have consistently been more elevated versus really the prior 5 years, looking at 2012 to 2016 roughly. As our nation is really continuing to face more frequent and severe natural disasters such as hurricanes, wildfires, and tornadoes, we're still awaiting final industry results for property line combined ratios. However, November report from Milliman, it was projected that property lines insurers could potentially reach a combined ratio of 109% for the year in 2021. And that means essentially for every dollar of premium collected, property insurers would be spending $1.09, translating to a fairly substantial loss for the year. Here, you can see the escalation of auto insurance inflation, which is the gray line, has unfortunately been outpacing wage growth, the blue line, with only a brief improvement at the outset of the pandemic, which we understand is having an impact on affordability for consumers. To help address these rising costs for auto, our industry is continuing to advocate at the state and federal level for better infrastructure, including reliable supply chains for critical auto parts and safer roads. That should help result in fewer accidents and ultimately lower claim costs that keep insurance premiums more affordable for consumers. Digging into the property trends a little further, we also recently published a research report explaining the challenges for property insurers. Similar to auto, cost inputs have soared, unfortunately, for property lines. Since the pandemic, we have seen an increase in demand for residential contractors and materials to construct new homes and also to complete remodeling projects. This demand unfortunately collided with record-breaking catastrophe losses and new constraints with the supply chain. The impact is that both residential construction services and materials have skyrocketed far higher than either inflation or homeowners insurance premiums. Looking at materials specifically, since the start of the pandemic, steel mill products have climbed nearly 140%, while lumber prices shot up 74%, with lumber futures much higher. Prices for gypsum, which is the main ingredient of drywall, have been up significantly, and copper prices have also been hitting new records. Home builders have also faced shortages of things such as windows and garage doors, appliances, and paint. Aside from the supply chain related costs, we have seen that 2020 and 2021 together resulted in the highest 2-year total for natural disaster losses affecting the 50 US states. In 2021 specifically, Hurricane Ida and also a severe winter freeze event in February led the losses in the US. However, ongoing drought is also a concern, which is increasing the wildfire exposure across the West. The lack of rainfall due to drought, combined with increasing average temperatures, due to climate change are leading, unfortunately, to longer, hotter, and drier conditions. These conditions weaken and dry out vegetation, and fire officials across Western states are observing a distinct change in fire behavior as a result. Reports are indicating fires are being started more easily and also spreading more rapidly, making them difficult to suppress and contain. We are seeing severe wildfire events at times of the year that were not typically considered wildfire season, such as the Marshall Fire in Colorado in December, and the wildfires currently burning in multiple southwestern states in the last month, well ahead of what has historically been the typical fire season. And we are seeing record acres burned and in patterns never seen before, such as the two fires last summer, the Dixie Fire and Caldor Fire, which each burned from one side of the Sierra Nevada mountains to the other, which was a first in recorded history. So far this year, through April 29th, the National Interagency Fire Center has recorded over 21,000 fires, more than any other year in the last decade when comparing to the same period, and a 40% increase over the 10-year average. And we've also seen over 1 million acres burned through April 29th, a 71.2% increase over the 10-year average. This trend of increasing losses in recent years, combined with these worsening environmental conditions, more exposures such as homes and businesses being built in high-risk wildfire regions, and the current spike in cost due to inflation has really created a perfect storm for property insurers. Now, insurers must purchase reinsurance, which is essentially insurance for insurance companies, to help pay for the potential claims that may occur for risk they insure. Given recent trends here in the US and abroad, these reinsurance costs have similarly increased, substantially adding more pressure to insurers, and including in some cases impacting the ability for insurance companies to obtain the necessary reinsurance capital for catastrophe events or within a reasonable price point. In these cases, some insurers may need to evaluate what level of risk they can underwrite while maintaining the ability to pay future claims, a term we refer to as solvency. These collective challenges are contributing to the affordability and availability issues that we're seeing in some of our Western states exposed to wildfire. While we are unable to control the increase in reconstruction costs or the change in environmental conditions, we do fortunately have the ability to influence housing policies, such as whether and how additional homes and business should be built in high-risk regions, including work to help address the structures that already exist to make these structures and properties more resilient to wildfires. Thus, all stakeholders are now recognizing and agree that mitigation is one of, if not the most critical policy solution. Widespread mitigation efforts should result in a meaningful decrease in losses, which should translate to more affordable and available coverage for consumers in wildfire-prone regions. Thus, this has been where our focus has been at the federal level and also at the state level. One of the biggest hurdles recently for wildfire mitigation has been the lack of a clear standard. Now, wildfire is a unique risk from other catastrophic perils, such as hurricanes, and that to effectively and meaningfully reduce risk, mitigation requires both structural adaptation as well as management of fuels, the latter of which must be done on a recurring basis. Also, this mitigation must be done for an individual property as well as the surrounding community, as wind-driven embers can travel from one property and ignite a nearby or adjacent property, creating a domino effect of losses within neighborhoods, as we've sadly seen in recent years. So this poses a very unique challenge for the insurance industry, which thus far, for most all other perils that we do insure, the industry has only needed to establish a standard focus on hardening a single home with validation done as a one-time event. So wildfire not only breaks that mold, but the industry has been in the process of developing what that standard should be and how it should be validated. However, we do have good news on this issue. In June, the Insurance Institute for Building and Home Safety, known as IBHS, they'll be introducing a new wildfire prepared home designation in California. And this translates essentially a decade of wildfire research they have done and pulled it from all of their technical reports into an applicable standard for homeowners to meet. Their designation will include a set of requisite mitigation actions that, when taken together, will significantly reduce a given property's wildfire risk. Their research stresses that mitigation for wildfire must be a set of actions to meaningfully reduce risk, meaning implementing only one or two will not be effective. And to obtain a designation for that program, the items that are most critical, which you can see here in brown, must each be done and verified, with some pieces that will need to be confirmed annually. In blue are additional items which have been shown to help further reduce risk and can be done to earn a higher plus designation. In time, IBHS will also be rolling out a community designation, as their research clearly and strongly indicates both individual home and community hardening are needed to meaningfully reduce risk. As I mentioned, this program is initially being rolled out in California this year before it will expand to additional states. But the information regarding how to mitigate a home is now publicly available to all through their website, which I've included on the slide. Similarly, state officials in California also just announced in February a new Safer for Wildfires framework, which very closely mirrors the science-based research of IBHS. Thus, we're seeing a coalescing around a standard for wildfire mitigation, which all Western states are beginning to explore as a key priority to help address wildfire-related challenges. And this includes Nevada through the efforts under AB 100, as Commissioner Richardson briefly mentioned earlier, and to which I appreciate the opportunity to speak on behalf of insurers in their December 14th meeting. So to recap, auto and property insurers are facing substantial pressure due to a variety of challenges, including inflation, supply chain constraints, climate impacts, and various other factors. Our industry has been very focused on identifying policy solutions that can help make insurance more affordable and available for consumers. For auto, continuing to focus on education regarding supply chain issues to help lawmakers identify ways to stabilize these needs, as well as continuing to promote policies that can help lead to safer driving and safer roads, which can in turn lead to fewer accidents and ultimately lower premiums. On the property side, as construction costs continue to climb, amid the growing frequency and severity of natural disasters, mitigation truly has emerged as the best policy solution to help reduce overall exposure and help communities to be more adapted to natural disasters such as wildfires. As an industry, our overwhelming priority is protecting what matters most, keeping families and communities safe. And when disaster does strike, insurers are going to be here to help our customers rebuild their lives and restore their property. Again, Chair Howdiggy, thank you. I greatly appreciate the opportunity and time to share some of these trends and challenges affecting insurers. Within these slides are links to our research papers for auto and home, which provides extensive background and insights on the challenges I highlighted for those who might be interested in learning more. So with that, I will pause and welcome any questions that you might have.
Thank you, Ms. Collins. I appreciate you being here to give us a presentation. As always, I'm going to start with committee members first. Committee members, any questions for Ms. Collins? Those on Zoom? Okay, well, I do have a couple. I just want to make sure I'm reading the graph right, but it was the driving returns to pre-pandemic levels, that graph. So, and these are miles in billions, correct? I know. So in 2019, like we were driving right under, around this time, we were driving right under 300 billion miles US, and now we're about 250, but we dropped in 2020 in April, we dropped to almost 150 billion. Is that correct?
From the initial stay-at-home orders, driving levels did drop, correct.
Okay. And then one of the other slides, and the other slides mentioned that there's been an increase. It's the personal and auto and homeowners loss ratio spike. So this is loss ratios, not actual losses, correct? Because I'm looking at the 2020-21 Q4 and it's showing a 72.9, % loss, increase in loss, but that's loss ratio. It's not actual losses, right? It's just the cost of the losses. Mm-hmm. Okay. And then I just wanted to make sure I was understanding everything correctly. And then my last question, it's just, because you ended with this and you touched on, the mitigation of natural disasters and what we can do, especially with wildfires. And here in Nevada, we have the two fastest warming cities in the nation in Las Vegas and Reno. It's a climate crisis for us now here in our state and across the country as well. And has the insurance industry, because this directly impacts you as well as providers of homeowner insurance, and having seen those two wildfires that destroyed communities in our state, I mean, have insurers partnered in any way with like the conservation community? I know we can take steps to mitigate, like make a home fireproof, but I think prevention is key as well, right? So have you guys partnered at all with the conservation community or taken an interest in what we can do to impact the climate crisis? Because unfortunately, if we don't do anything, it's going to mean more wildfires. Which is going to impact the industry.
Yeah, no, there's a lot of outreach that our industry has been doing on a number of fronts to promote resiliency and addressing the challenges that are obviously affecting our communities. I can't speak to each individual member company. There's a lot of individual companies, as well as the efforts of various trade associations that are working at the federal and the state level, working with lawmakers to help educate on these issues. Ecoforestry is an area that we're looking at closely. Certainly the need for lumber and having sustainable practices, and recognizing that ongoing storms create losses, which will create a repetitive cycle of rebuilding. And we want to have all of these issues looked at and approached in a very responsible manner. So there's a lot of outreach that is happening, a lot of conversation on what we can do as an industry. And those are certainly areas that we're looking into.
Thank you. And I learned about the mitigation, the California mitigation strategy, just I think a couple months ago, because I was being proactive and saying, like, if this is going to become our norm, wildfire seasons, destroying communities, what can we do? I know that this would impact home ownership in some way, but will there be? Because I believe this California is doing this. And I don't know if it's doing it like citywide or on a homeowner basis, but would there be any type of incentives or reduction in rates for homeowners that do the whole wildfire prepared home or take action? Because we can have these standards, but we have to encourage them to.
Right. There's currently a number of carriers in California that are, to my understanding, offering discounts on a community-wide basis for home hardening, and those are often done through what is referred to as the FireWise program. One of the challenges that has faced our industry with wildfire and what we refer to as premium credits for wildfire mitigation is that while we directionally know that wildfire mitigation will lead to fewer losses, the economic analysis of that, the actuarial science behind that is still underway to quantify what that mitigation, discount would translate to. So we're trying to approach this cautiously as an industry so that we don't get too far ahead of ourselves and create more challenge or adverse impact if we try to overextend before we're actuarially, supported on what those should look like. So there's some hesitation by some carriers to do that, but there are some carriers that have moved forward. And so we just encourage folks to, shop around if those companies are offering those potentially in the state of Nevada as well.
Okay, thank you. And that's actually all I had for you. So I'm going to do last call. Oh, I'm going to go to Vice Chair.
Thank you. So I just had a real quick question. I know a few years ago, some of the home builders were using some different types of materials as part of the sustainable development. Have you looked at anything like that might be implemented across any particular industry or sector that might help to reduce the number of losses during wildfires?
We are absolutely looking at what materials and construction approaches will result in more resilient structures. We know that we can adapt homes to be resistant to the ember storms, things such as enclosing eaves and vents and making sure that certain vegetation is not right up against the home so it doesn't create, obviously, an opportunity for the home to ignite. We can't prevent ultimately every home from burning, but we can certainly reduce that substantially. And as far as the individual materials, this is where I tend to defer to IBHS in their research as being more experts in the individual, construction techniques and materials and the builder, trades as well. But there are certainly standards and clear options that are available that make a home more resilient. And we're certainly looking at what is also sustainable within that as well. Hopefully that answers your question.
Yes, ma'am, it does, but it gave me another question too. So if that is the case that you're looking into it, have you all looked at any type of possible collaborations with the way that building, residential and commercial, those aspects are going on right now to maybe look at integrating whatever the concerns are and whatever the mitigations are in place right now, overlay those as a template on what the building industry, the construction industry is looking at, and perhaps come up with some type of a hybrid solution that could be implemented down the road. But because you're working in tandem with them, it wouldn't be like they create this and that. Now you got to figure out how to get in there and make it fit. Does that make sense to you?
Right. No. Yeah, no, our industry is really about bringing together all of the stakeholders and working collectively for the broader benefit, of course, of consumers and our policyholders. And so the construction trades, the building trades, amongst many other groups, are organizations that we are collaborating with. We've had many conversations with them following the Marshall Fire right now that's going through that reconstruction effort. Similarly, within other coastal states, and really understanding that there are standards. IBHS has excellent standards that they're putting forward. They are essentially the research arm of the insurance industry as a nonprofit, and they have worked closely with the building trades and the international code councils in developing what should be WUI specific, wildland urban interface, WUI specific building code standards. And our organization is generally promoting states to, adopt those standards and enforce those standards, including after, rebuilds where there's really the best opportunity for the reconstruction, incorporating all of those codes and techniques so that those properties are more resilient and not just going back to a pre-standard.
Thank you, Vice Chair. Committee members? Those on Zoom? Okay, Ms. Collins, thank you so much for being here. We appreciate your presentation. Thank you.
Thank you.
Committee members, that takes us to our last agenda item number 8, which is public comment. I am going to go to see if there's anyone here in Carson City, in Las Vegas. And seeing no one here, is there anyone in Carson City? Okay, BPS, could we check the telephone line for anyone wishing to give public comment?
Yes, Chair. Currently, the public line is open and working, but there are no callers at this time.
Thank you, BPS. Okay, committee members, any comments from our committee members? Okay, then that concludes our meeting for today. Members, our next meeting is scheduled for June 20th, 2022, beginning at 9 a.m. We are adjourned.